Welcome back to the channel, ladies and gentlemen. So in this video, we're going to talk about a program that allows you to move into your dream home with as little as a 550 credit score. This program can work for people with bad credit who are looking to rebuild their credit. It could work for self-employed people as well as people who don't have a down payment for a home just yet, and you want to be able to live in your dream home while saving to actually buy that dream home. So there are pros and cons to this program. I will be talking about the pros and cons to the program so that you can make your own decision in this video. So you have to watch the entire video because it is a value packed video. I talk about stuff that a lot of people have not talked about in regards to this program in this video, because I have spoken to representatives and I have went through the application process myself. So I've gathered different data points. So you definitely want to watch the video. Make sure that you subscribe if you want to see more videos like this, and hit the bell icon to receive notifications on when I drop new videos. Now, if you are watching this video and you have bad credit, you definitely want to check out our DIY credit repair guide. It comes with information on how to structure your credit reports, information on how to remove negative items such as collections, repossessions, evictions, and more. We also give you a list of no credit check credit builder accounts that's going to help boost your credit score even before you remove any negative items off of your credit report. Also a secret lenders list that you can learn, exactly what credit bureaus each lender pulls from, so that you can strategically apply for different credit cards without getting a bunch of inquiries on one credit bureau and more. So definitely check this out. It's on sale at 50% off right now at the time of this video. Link is in the description. Definitely got to get this guide so that you can clean your credit report, so that you can be able to buy that house, buy that dream car, etc. Having bad credit is a no-no. Also, if you are self-employed and you want to buy a house, there is something that you can do to get a home loan using just bank statements. They have something called self-employed bank statement mortgage loan. So you don't have to show tax returns, and you can get that full qualification based off of your gross income. They'll usually take 100% of your personal bank statements, or if you show business bank statements, they'll use about 50% sometimes, depending on the lender, of that income that you show with your business bank statements to qualify you. Now, the only thing about that is they will actually require that you have a higher down payment, such as 10 to 20% of the purchase price of the home. So even if you do this program, you can still save your money to be able to have that down payment and then turn around and get a bank statement mortgage loan, which I'll talk about that in the future. It might be the next video. All right, so in order to get approved for the Divvy Homes program, you will need to have at least a 550 credit score. They will be checking TransUnion. They will do a soft pull on your TransUnion credit reports. Also, you will have to have your down payment. You will have to have a 1 to 2% down payment of the approval amount that you get. So say for instance, you get approved for $300,000. You'll need to have 1 to 2% of that $300,000 to get into your home. Once you find your dream home, the home that you actually want to move into, Divvy is going to purchase that home for you, and then you'll pay Divvy rent. So here is some of the cons to this program. You're gonna have a higher rent payment because they're gonna actually factor in a savings amount. So you're gonna have a 5% to 20% savings of your rent that they're going to put towards your future down payment when you're ready to purchase your house. So that goes along with that 1 to 2% down that you're gonna put down. So right here where it says initial payment, you'll make a one-time upfront payment of 1 to 2% of your home's value that goes straight towards your savings for future down payment. And then also some of your rent payment goes towards that savings as well. It's actually approximately 10 to 25%. So for example, on a $200,000 home, approximately $200 to $500 per month of your monthly payment goes towards your home savings. Now, this sounds good and all, but here is the kicker. What if you decide you don't want to move into this house or want to actually purchase the house after a year, after 18 months? What if you get another job somewhere else? What if you have to relocate to another city and you can't purchase the home? You decide it's not going to be right for you. This is what's going to happen. So right here where it says, am I locked in for 3 years? No, you're not going to be locked in for 3 years because they have terms from 18 months to 36 months. Okay, whichever one you choose is up to you, but you're not going to be locked in. You have to give them a 60-day notice if you plan to move. Now, you'll get to keep the savings you built with Divvy minus a relisting fee. Now, this is the big problem. The relisting fee is that 2% of the purchase price that you put down as a down payment. They're going to take that from you if you decide not to buy the house. So you have to be sure, you have to know that you're going to stay in that house and purchase the house at some point. Because if you get into this contract and you decide you don't want to purchase the house, that's $6,000, $5,000, how much you put down, they're going to take that from you. Now you get to keep the other portion, the monthly payments that you paid into it, the savings portion, that additional savings that was a part of your monthly rent, you'll get that back. But the first down payment that you paid, you won't get that back. So that is really not good. So in my opinion, this program is kind of borderline predatory. It may be a good option for people who are, kind of sure that they're not going anywhere and they found a home that they are for sure intending to buy. They just need to save up a little bit more money. They want to lock in that house so no one else can take it. Then it's kind of a decent idea, but at the same time, there are additional fees on top of that. So if you purchase a house, for example, $400,000, whenever you decide to, if Divvy purchases the house for $400,000, whenever you decide to buy out the house from Divvy, buy it back from Divvy, they are actually going to charge you a fee. They're going to charge you. This is what I got from one of the support representatives. So if you decide to buy the house before the 18-month period or the 36-month period is up, you're going to have to pay the purchase price of the home plus appreciation. So I need to clarify this a little bit more with the representatives, but they said that on average, it's about 1 to 2 or 1 to 3% per year appreciation according to your zip code. It's really going to depend on the appreciation rates in that zip code that you purchased the house. Now, her email is kind of confusing because, so she says that they have 2 different buyback prices. So they have one before 18 months is up, and then they have another one during 18 to 36 month period. So after 18 months, and then that price is determined again based upon your zip code that you buy the house in, their appreciation rates per year. So she said, which is usually 1 to 3%. But if you go over to their website, now let me go back because I pulled this up earlier. If you go to right here where it says search homes, also they are only available in certain markets. So their markets are here in the footer. It changes sometimes. They have added new markets like Macon. I don't think this was on here before, like months ago. So these are the markets that they offer their services in. Looks like it's Georgia, Texas, Florida, and Ohio. Also Arizona, and then Missouri. So if you click on search homes and then you click on an area, so I'm going to select for this video Houston, view homes. It's gonna pull up some homes in the Houston area. Now, if I click on one of these homes, like this one right here, this house is a $400,000 house. The monthly rent, they're estimating $4,000 and $4,075 per month. So the rent breaks down to $3,000 for the rent, and then you're giving them $985 to go towards your savings. Now, this is supposed to be fair market rent prices. If you decide to buy the house before the 18 months is up, you're gonna have to pay an additional $32,000 for the house. Prices could drop in 2023. Say, for instance, if you decide to rent this house this year, and by this time next year, the prices dropped a little bit, or maybe they only went up 15 to 20,000. You'll be overpaying regardless. There's no guarantee that the price for a house like this will go up to $432,000. It's kind of a gamble. Now, if you customize the pricing, FYI, I did do an application. I was approved for this amount, just to see how the program works. If I decided I only wanted a $350,000 house, these would be the numbers. I would have to pay $7,000 down. The rent would be $2,900, which is still over. For a $350,000 house, the rent down here is like $2,500 to $2,600 a month, depending on how nice the house is. It's not this much. And then I have to pay an additional $800 to save. And I believe this is the minimum amount you have paid towards your savings for their program. So you have to give the $860 towards the savings. So if you decided to buy the house within a year, you'll have almost $12,000 saved, and then you'll have that $7,000. So that'll make almost $20,000 towards the down payment of your home, but the price went up $30-something thousand. So this is my review on the Divvy Homes program. I don't really think it's all that good of a program, because you're kind of gambling and you're kind of overpaying for the house, essentially, because you don't know if the price is going to drop, especially the way inflation and things are going, and then you're overpaying for rent. Now, it could be a good idea if the prices of homes continue to go up. You'll be locked in that, price, whatever the buyback price is. If it's lower than how much the house is actually worth within 18 months, you save some money. But in these conditions, it's kind of a gamble. So you can make your own decision about this program. You can go ahead and decide to sign up if you think that this is a good fit for you. You can sign up for this program. You'll be able to move into your dream home. If you plan on staying in that dream home and buying the house, you'll be able to keep that house and not have to move again. Whenever you're ready to buy it, you'll be able to buy it. So that's it for this video. Thank you for watching. I'll see you in the next video.